Right. Let's just dive right into this explainer and untangle the incredibly chaotic web of e-commerce bookkeeping that is, let's be honest, probably wreaking havoc on your QuickBooks Online ledger right now. If you're an online seller, you already know that keeping your books accurate kind of feels like trying to solve a giant puzzle while someone else keeps hiding the pieces from you. You know that moment of sheer panic when you open up your books and see your revenue drastically, artificially overstated? Yeah, you are absolutely not alone there. It's a shocking moment when your profit and loss statement says you made double what you actually did in reality. And it almost always comes down to this invisible workflow error that so many business owners fall into without even realizing it's happening. So, to rescue your financials today, we're going to follow a very structured roadmap. We'll cover the triple counting nightmare, gross versus net payouts, enter the automation apps, the clearing account secret, Shopify and Stripe quirks, and finally, reconciling like a pro. Okay, section 1, the triple counting nightmare. We really have to start with the true villain of our story here, which is manual data entry and the dreaded direct bank feed adding mechanism. This is exactly how untrained users accidentally record the exact same sale 3 separate times in QuickBooks. Think about it. First, an app correctly pushes your Shopify sale over to the ledger. Great. But then you see the money hit your PayPal bank feed and you manually click Add as income. And then, finally, when PayPal transfers those funds to your actual business checking account, you see it in the checking feed and you click Add as income again. Boom. Suddenly, one single sale has become 3, creating an absolute nightmare on your P&L. Moving right along to section 2, gross versus net payouts. To understand why that triple counting happens, we've got to look at the journey of a single dollar. Because in the e-commerce world, a single bank deposit does not equal a single sale. Take a seemingly simple $8,500 deposit from Stripe, for example. If you peel back the layers, it's actually a Frankenstein's monster of gross sales, refunds, processing fees, chargebacks, and reserve holds. If you just lazily record that $8,500 net deposit as revenue in QuickBooks, you are literally understating your actual sales by over $1,300. And worse, you're completely hiding hundreds of dollars in deductible business expenses from your tax return. Which brings us to section 3, enter the automation apps. Look, you simply cannot manage that level of math manually every single day. It's impossible, which is why we've got to introduce the real heroes of this explainer, automation integrations. Let's compare 2 leading solutions that fetch, categorize, and map your data from platforms like Shopify and Stripe directly into QuickBooks. You got A2X, which is widely considered the industry gold standard for highly precise, accrual-based e-commerce accounting. And then you got PayTraQer, which is a super user-friendly and cost-effective option that really excels at pulling in multi-channel data, like if you have Shopify, Amazon, and Square all running at once. But the point is, both of these tools completely eliminate manual data entry. Now, when you're setting these apps up, you're faced with a really critical choice. How do you want the data to actually appear? Well, for the vast majority of multi-channel sellers, Summary Sync is the superior default, for sure. It posts one clean entry per payout, keeping your books totally clutter-free. Actually, scratch that. It's not just clutter-free, it's perfectly organized. Now, unless you are a B2B business that absolutely needs individual customer invoices recorded in QuickBooks, avoid itemized sync. Seriously, it will flood your ledger with thousands of individual transactions and drive you crazy. All right, section 4, the clearing account secret. Without this next concept, automation apps literally cannot do their job. Setting up this specific account type, rather than just dumping data directly into your checking account, is your secret weapon. Think of a clearing account as a temporary digital waiting room. Your automation app drops all the gross sales, the refunds, and the fees into this room so they can all be calculated together. By routing absolutely everything through this waiting room, your automation app builds an exact mathematical bridge between your gross sales and your net bank deposits. You map the sales in as income, you map the fees and refunds out as expenses and debits, and what's left over, just sitting there in that clearing account, that is the exact net amount that Shopify or Stripe is about to wire to your real-world bank account. Now for section 5, Shopify and Stripe quirks. So, even with automation and clearing accounts perfectly set up, these platforms have some really specific, kind of wild quirks that will ruin your books if you ignore them. These hidden realities can slowly drain your margins while hiding right in plain sight. For instance, did you know if a customer pays with PayPal on your Shopify store, PayPal takes a cut, and then Shopify takes an additional transaction fee? That's 2 separate fees you have to map.
Or over on Stripe, if a customer files a dispute, you're instantly hit with a $15 fee. And get this, if you generously refund a customer, Stripe gives back the percentage fee, but they keep the 30-cent fixed fee. You are literally paying 30 cents just to give money back. Unbelievable, right? All of these have to be mapped to distinct expense accounts.
And we have to talk about gift cards for a second. The crucial point here is that miscategorizing liabilities as income will artificially inflate your profit. If someone buys a $50 gift card, that $50 isn't yours yet. It's a liability. It's an obligation to deliver goods in the future. If your app pushes gift card sales into your standard revenue account, you'll end up paying income tax on money you haven't actually earned yet. And nobody wants to do that.
Finally, Section 6, Reconciling Like a Pro.
Now that we know the traps, the tools, and all those platform quirks, let's establish the final foolproof workflow to keep your ledger pristine every single month. By following 3 simple steps, your bookkeeping essentially runs itself. First, the app does the heavy lifting in the clearing account. Second, it creates a digital transfer from the clearing account to your checking account. And third, when the real money actually lands in your bank, QuickBooks will look at it and say, hey, I see this deposit and it perfectly matches the transfer the app just made. Just like that, your checking account reconciliation becomes a one-click process.
Which brings us to the absolutely most important takeaway of this entire explainer, the golden rule of the bank feed. If you see a deposit from Shopify, Stripe, or PayPal, never click Add. Always click Match. I repeat, do not click Add. If you manually add a deposit in the bank feed instead of matching it to the app's transfer, you're instantly double counting your revenue and plunging yourself right back into the nightmare we started with. Always, always look for the green match symbol.
So, I want to leave you with this question. Take a moment to really think about it, because unlocking accurate, automated financials isn't just about tax compliance or, keeping your accountant happy. It's about reclaiming your time. No more late nights trying to reverse engineer a random Stripe deposit. By letting systems do the math, you finally get to step back, take a breath, and build the business you actually envisioned.